Good morning, everybody. Good afternoon in Europe. I'm Pengguo Wang from University of Exeter in the UK. Today, we are pleased to have Professor Ray Bull from Chicago University to present his paper entitled FASB was right, earnings beat cash flows when predicting future cash flows. I don't think I need to introduce Professor Bull. His paper with Philip Brown, empirical evaluation of accounting income numbers, published in 1968, revolutionized our understanding of the economic properties of accounting earnings and how they are related to equity prices. This and other fundamental research have influenced all of us in accounting and finance research. Ray would like to present in the first 5 minutes without interruption. So to save time, please have a look at a few housekeeping rules in the chat room. I'm going to post some housekeeping rules in the chat room. Ray, I pass it to you now, please.
Okay, Pengguo, thank you for that introduction. A couple of things by way of background. First, this is a simple little paper with a simple message. Second, the version you have on the website's an old version, which has an unfortunate error in one of the tables. I'll go through that in a minute. Third thing by way of background is if I seem spacier than normal, my wife and I had food poisoning yesterday, and so you dehydrate, and when you dehydrate, you tend to lose focus a bit. So I'll be more spacey than normal, okay? But thanks for inviting me. So here's a bit of a summary of what I'm going to go through, why this is an interesting topic, where it arose from, the Trueblood report, basically, how to measure cash flows, the Notorious FASB study, what we think is wrong with it, then our approach to it and our results. Okay, that's basically the focus. So it turns out back in the 60s and 70s, the empirical work that was developed tended to focus on users and what they do with accounting numbers. And there were two very early tests developed in the 60s and 70s as to whether or not earnings incorporate more information than cash flows. In other words, do accruals add anything? There was, first of all, the work on whether earnings are more highly correlated with stock returns than cash flows. Phil and I did a very coarse job at that in '68. Paddy Duchau's thesis paper is obviously a foundational paper in the literature in that regard. Second test category was, do earnings exhibit a higher correlation with future operating cash flows? I think the first significant paper on that was the Bowen, Bergstaller and Daly paper. And then there's been quite a literature ever since. And there's this famous FASB proposition, widely cited. I think there's one sentence of it that is read a lot, and the rest of it is not very widely read, on predicting that the answer to that question will be yes. And then there's other evidence that's accumulated. We won't be talking about do analysts, what analysts forecast? Do they focus mainly on earnings or cash flows, or to what extent do they mix one versus the other? Contracts, do various contracts specify payoffs as a function of earnings or cash flows? So there's been a fair bit of work on earnings versus cash flows, but we'll be focusing on number two, which is the relation between earnings and operating cash flow. So this is the notorious FASB proposition. The first paragraph is widely cited. It says basically, if you're interested in forecasting future cash flow, don't look at current cash flow, look at earnings. But then in the next paragraph, they say, and this is the part that's not widely cited, is information about enterprise earnings and its components measured by accrual accounting give you a better indication than do current cash receipts and payments, okay? Now stress that and its components. So part of the background of this, first of all, in the 1960s, it started to become accepted that you could think of value or prices as present values of cash flows. I had a personal experience with that when I was a young man, young boy. probably about 1920. I was the TA in a finance professor's class, first finance professor I ever met. And when you're that age as a male, you do stupid things like drive too fast. And I argued with the guy, and obviously on seniority grounds I lost, but he said, we will never teach the present value model in a finance class. It's not practical, okay? And obviously that changed. What changed in my view was handheld calculators and computers made implementation possible, okay? So that's part of the background, focusing on cash flows. George Storbus's famous book, he introduced the notion of decision usefulness. Well, he didn't really introduce it. He was a link between people before him, in particular Vatter at Chicago, and people like Storbus and Holmgren. And he developed the notion that it's important to give decision makers useful information about future cash flows. Then the Trueblood report came along. And that was a very foundational report. And they stated their version of what FASB if you want to know something about probable cash movements in the future, the periodic measurement of earnings becomes a basis for those estimates, okay? And as Steve Zeffs pointed out, that influenced a lot of standard setters around the world. And then finally, a final step was just after this, in 1976, after the Trueblood report, present values had become generally accepted as a way of thinking about value. And FASB said it is generally accepted in the United States that we could view the present value of a sort of lease payment as some measure of an asset and a liability, okay? So that's part of the background, but it's an important issue in its own right. Even if the FASB hadn't raised this proposition, even if Trueblood hadn't raised it, it's a test of whether accrual accounting actually adds information. So that's background, okay? There's not much tension in this.
Can I stop you for, I think Peter has 2 questions for you. In the chat box, can you see the chat box?
Or Peter, do you want to ask your questions? Like you type in the chat box?
Yes, I'm happy to do that, but I see Ray's in the middle of reading it. I have a couple of 30,000 feet questions, Ray. The first is, if earnings is a good predictor of future cash flows, then it seems to me that future cash flows in the next period should not be the variable that we're predicting per se. In other words, next period's earnings will be the best indicator of the future cash flows. In other words, any one cash flow variable is not adequate. And we're using next period's earnings as a summary of all future cash flows. Now, I see what you're doing. What you're doing is setting the record straight. And therefore, you're following another reading.
Okay, so one of the results that's good, yeah, Peter, one of the results is going to come up that's not well laid out in the draft of the paper you have, is we'll look at a 2-year horizon and longer horizons. It turns out there's a big difference in whether you're predicting cross-section or time series, okay? So what happens in this literature is you scale the variable cash flow or earnings by total assets. And there's substantial cross-sectional variation in firms' return on assets, right? Okay, due to a number of things. One is who invested at a higher rate than someone else, right? So there's profitability differences exposed that are there. And if you invest long-term, these will persist over time, right? Secondly, you've got differences in how you calculate book value, okay? Intellectual property versus intensive firms versus others. And so it turns out that the most accurate, we believe, estimation of this proposition is in time series rather than cross-section, unless you can find a way of controlling in cross-section for what is a time series invariant effect like fixed effects, okay? So I think that's related very strongly to your question, okay? And it turns out we've looked at so far 2-year ahead horizons predicting. I suspect if we go out much longer, we'll still find the same results. Okay.
Yeah, I think that's critical. In other words, 2 years of cash flow was much better than 1 year of cash flow. 3 years is better than 2. In other words, it's the whole.
In fact, in the 2-year results, in the 2-year results, earnings subsumes operating cash flow. Okay, operating cash flow is wiped out in the 2-year results. So we'll get to that a bit later. Okay.
Okay. The second
was another question, right?
The second question is why operating cash flow? Why not free cash flow?
Yeah, well, we're working on that too. It turns out the results are the following. Okay. The best predictor of free cash flow is earnings where you replace depreciation with current CapEx. So if you take earnings in T minus depreciation in T plus CapEx in T, okay, it's a really good predictor of future free cash flow. And so that raises the issue of what is the time series process generating investing cash flows. And our suspicion is that, based on casual evidence, that investing cash flows come in bunches. So are you a growing firm versus not a growing firm, for example? And so what will happen is over near term, okay, last year's investing cash flow is a poor predictor of next year's, okay? Sorry, the average of last year's investments, which is depreciation, right, is a poorer prediction of next year than this year's investing cash flow. Okay?
Yeah, because of the lumpiness.
Depreciation is obviously just either a simple or a weighted average of past CapExes. So it's got sort of a distinct lag structure in it, okay?
Yep.
If you change the lag structure and just insert the most recent observation, you get the best predictor.
Got it.
Can I, Stephen here, Ray,
Okay, so
can I just add to that?
hey, Stephen. Sure. Yep.
Yeah, listen, this cash flow from operations, it's a rather difficult number. CapEx goes into investment, but all the other investments in R&D, all those intangibles in SG&A, they have cash flow from operations. So cash flow from operation, it's a number. It's actually partially free cash flow because it has a lot of those investments in there, except CapEx and some acquisitions.
Yeah, two responses. One is we've been doing a lot of work on what happens if we adjust the earnings number for R&D, try to get at the cash and accrual component of interest for non-cash based compensation, okay? We've been doing some work on that. But the second answer is that essentially what happens in the answer I was giving to the previous question, Peter's question, is if you adjust earnings for the current CapEx rather than depreciation, you're basically putting expenditures on real capital on the same basis as expenditures on intellectual property. Okay, because you're then deducting them both. So that becomes a sort of that's part of the logic for doing that calculation.
Yes, I see that. I see that.
Hi, Ray. It's the same as a lot of questions. So now Stephen has a question. Stephen Monahan. Stephen. So Stephen, can you hear me?
Yeah, I can hear you. Sorry, I was muted. Sorry, that was my fault. My apologies. So Ray, given the results in Dachau and also Nichols and Whalen, where they do basically what you did in 68, but they also put cash flow in the sort of cash flow increases, cash flow decreases in the analysis. Is the underlying hypothesis in these papers that the market might be inefficient because it's using the earnings data more than the cash flow data? in terms of the relation with contemporaneous returns, but that it's possible that still the earnings data wouldn't predict future cash flows better?
Yeah, I can't answer. I haven't looked at that closely, so I haven't really thought it through. In terms of you were talking about predicting returns, right?
No, I'm talking about just contemporaneous relations with returns, right? Like if changes in prices reflect revisions and expectations about future cash flows, and Nichols and Whalen's they do the same graph you did in 68, but they also have increase or decrease in cash flow from operations. And Patty, well, you know better than I do what Patty did. So if you think about it, those papers throw a strong relation with sort of value creation or destruction and the sign of the earnings, right? Or a strong, in Patty's case, continuous relation, which suggests the market's pricing earnings, right? More than cash flows. And so is the motivation behind these studies that look at the relation between current and future cash flows that the market might be getting it wrong?
I don't believe so. I also don't believe that the announcement effect type of studies, okay, unless you do it the way Patty DeShao did it in her thesis paper, have avoided the difference in expectation models for cash flow and earnings. So basically what you have to do is if you're doing, say, a Nichols and Whalen, you're doing a binary analysis. You're classifying on the basis of the sign of a surprise. And it's not clear that their model is equally well specified for earnings and cash flows. Okay, so I've always been skeptical of that sort of exercise. And I must say, Bill and I sort of are guilty of having introduced that sort of design, but it's a limited purpose design in my view.
Right. There are lots of questions. I think Stephen Penman has a question for you.
No, I'm sorry. I asked my question. I did it by butting in rather than waiting for you. I do apologize.
Right. So you have a question, right?
Hi,
No,
Ray. Yeah. I have also the very high level kind of conceptual question. So I think this fall workshop series, we started from double entry accrual accounting system versus cash flow accounting system. And then till this talk, I just want to know, like, high level, regardless whether what FASB has stated, what our accounting accrual information really want to predict or forecast or capture. Is that 12 months cash flow in the future, or is that the expected cash flow perceived by investors, capital providers today, or is some fundamental transactions in the future or today? That's what exactly this accrual accounting system aim to capture. So that would guide us on what would be the appropriate dependent variable in the regression to run a horse race.
That's a Stephen Penman question. And he's the person best able to answer that. But my view, and I've always taught accrual accounting to introductory students as saying that ignoring capitalization of gains and losses, ignoring that, I always teach them to think of earnings as value added in arm's length transactions. Okay, just think of it that way. And if value involves some forecasting of a cash flow, that's fine. Okay, so if you make a credit sale, okay, you're adding value to the firm. Okay, other things equal, they're ignoring expenses, right? The credit sale, other things equal, adds value to the firm, and the valuation involves, in that case, forecasting the amount of collectibles. Okay, and so I don't regard the forecasting as per se the model that generates the result. okay? But there's an implication from that model that it will forecast.
Okay, I think it's better we move on.
Okay, so this slide very quickly, there's not much tension in this. The tension is, although there are some people who believe that accrual accounting is just a big joke. I know a lot of finance professors view it that way. So the alternative hypothesis is that accruals are uninformative either because they're inaccurate, right? Or, you know, the gap could be bad, or there could be errors in applying gap, or the accruals could be manipulated by managers. The accrual accounting is the only source of any information advantage of earnings over cash flows. That's the essence of FASB's famous proposition, okay? It's well known from the Dutina and Lage paper. It's worth reading in retrospect. They're the first people who pointed out that if there's a change in the accounting entity during the year, using balance sheets to estimate cash flows introduces errors, and they were arguing for what ultimately became FAS 95, okay? I should point out the last row on this, if you're measuring working capital accruals from statement of cash flow data, you also have a problem with firms that report non-classified balance sheets. There are some firms where it's very difficult to tell whether a receivable is due within a year or not, okay? But still, nothing's perfect. So then there's an Elleredian study. It's a very well done study. They use cash flows from cash flow statements. It's a very, very thorough analysis. They're impressive and seemingly robust results. Overall cash flow outperforms earnings in predicting cash flow. It's comprehensive. I mean, it shows up in every research design they have, and they try research design after research design. Yeah, it's even an international study. The magnitude is impressive. Cash flows outperform earnings on average by a factor of 1.56, which is quite remarkable, okay? And the significance, you don't have to do any t-tests or whatever to test this. It outperforms earnings every single year from 89 to 2015. What's that? That's 27 years. So 27 out of 27. And every single year in international sample, well, what's that? 13 years, okay? So it's obviously large, the difference, and significant. So this is their conclusion. They basically say FASB and IASB should find our evidence relevant. It challenges the notion that earnings as a summary metric is a better basis for predicting future cash flows, okay? So we're skeptical about that, right? First of all, you know, you can't, in evolutionary systems, you can't be guaranteed that the structure that arises economically will be an efficient structure, right? You can't guarantee that, okay? But still, you might ask the question, why is it that in so many different jurisdictions, so many economies, have we put out this substantial costs of creating accrual accounting when accrual accounting seemingly reduces the earnings, reduces the information in earnings, okay? Why does Wall Street follow earnings? Why do debt contracts use it? Why not throw out all the gap, almost all of it? Okay, why bother teaching accrual accounting? I mean, if it turns out that cash is the better predictor of future outcomes, okay, it would mean that teaching introductory accounting would be a lot easier. You struggle to get accruals across to students, okay? And you can throw out intermediate and advanced accounting. I mean, why teach accrual accounting? Why not simply just deal with cash flows? So we looked at this paper and said, do the results make any accounting or economic sense? They didn't seem to do, okay? And so here are some test design issues, okay? If you run a horse race between operating cash flow and earnings, okay, you handicap earnings if the earnings variable includes non-operating components that are not present in the cash flow variable. So you can think of this as bringing in non-operating components of earnings, okay, that by definition are not related to operating activities, and by definition are uninformative about operating activities, okay? And the extent to which these non-operating components are present in earnings varies substantially in cross-section. Okay, and just have a look at different types of companies and have a look at the cross-sectional variance. So you're introducing noise in the cross-section if you introduce non-operating components of earnings, okay, through the earnings variable. Secondly, if the earnings variable has transitory components that are not present in cash flows, and if no allowance is made for firm heterogeneity, okay? And income before extraordinary items and discontinued operations is especially affected by all three. And that's the base case in Nel Iridianor. In fairness to them, I should point out, they actually test another 13 different cases. Okay, it's extraordinarily thorough, okay? A little footnote, buried in a footnote 11, there's a statement in one case, earnings does beat operating cash flow. They have an appendix C that lists, I think it's 8 plus a number of others, which shows that in every combination, cash flow beats earnings, okay? So our rules for testing this proposition, this Trueblood / FASB proposition, is that the only difference between the two variables being studied, earnings and operating cash flow, should be accrual accounting, okay? So we ask the question, what do you learn from comparing an accruals version of earnings variable A with the cash version of earnings B? What does the comparison even mean? You know, does it test the essence of the FASB proposition? So our rules are, we say, look, what we want to do is also impose minimal restrictions that the financial statement user doesn't encounter. Notably, we know that analysts don't analyze every single company's earnings and cash flows the same as every other company. Okay, they adjust for real differences in the companies, okay? It's bad enough that we're going to stick to ordinary least squares, but ordinary least squares running a cross-sectional regression where you assume that everything is invariant with respect to the company, okay, is a serious restriction that the user does not have, okay? So here are the variables we studied. So how's my time going? Okay. They're listed here in the order in which we think they are valid in representing an accruals version of operating cash flow. I've got here CF, it should be OCF, operating cash flow. And what we predict is their ability to actually predict future operating cash flow. First, obviously, is cash flow. Second is income before extraordinary items and in the cash flow statement. Then there's another version that we construct ourselves where we make a number of other adjustments to income before extraordinary items. Then operating income before depreciation and amortization. That's the variable that Phil and I used in 68 because we didn't have any better data. And then our favorite is the Dachau to Chev operating earnings variable, which is basically operating cash flow plus changes in operating accounts, okay? And so that's our favorite variable, okay? I should point out for OE, we take the data from the cash flow statement, not balance sheets, okay? So here's some sample statistics. First of all, I've highlighted IBC, next near bottom line earnings. This doesn't include extraordinary items, which are pretty rare anyway. This is income before extraordinary items, okay? If you look at it, its first quartile is negative. That's consistent with what we know from the literature. About 30% of annual earnings numbers are negative. If you look at it, its mean is way below its median, and there is way below the other variables. If we look at our favorite earnings variable, operating earnings, it has a correlation about 0.6 with cash flow, so they share about 36% of their variance in common. And so it's not going to be perfectly easy to differentiate between one and the other because they can be because they are correlated, but they're not that highly correlated. They share about a third of their variance, okay? So here's our first set of tests. Simple univariate regression. These are annual cross-sectional regressions. We're going to run a cross-section every year, regressing future cash flow on a predictor. The predictor will be either earnings or operating cash flow, and there'll be different earnings predictors because we're trying different earnings variables. So here we have, first in blue, okay, in cross sections, okay, cash flow this year explains only about 1/3 approximately of the variance of cash flow next year in cross sections, okay. The R squareds are about 0.33 to 0.36, 0.34 to 0.36, okay. Secondly, in cross sections, IBC does much worse than cash flow. This is the Nella-Reddy and all result, okay. It explains less than 1/4 of the variance in 1 year ahead cash flows. I mean, that should be a warning sign. That's low. I mean, that strikes me as just in terms of magnitudes, says, hey, maybe this is not the right variable, okay? Then we get down the bottom, our favorite variable, this is in cross sections, no fixed effects. By the way, there are 31 years here. So these are the means and medians of the cross-sectional R squareds, and the R squared difference is positive and just marginally significant, not much to be excited about for operating earnings. It does at least as well as operating cash flow, or possibly slightly better, okay? So we get the first result. It depends upon how close the variable that you are looking at for earnings is an operating earnings variable. The further away it is from an operating earnings variable, the worse it does in predicting operating cash flow, which is what you pretty much expect, okay? So here we run horse races. This is now where we have the two predictors. The first result is, once again, IBC loses this near bottom line earnings, loses the race by a large margin. The T-stat on cash flow is 34. The T-stat on earnings is 19.6. That's the mean and the mean T-stat from the cross sections. All the other variables win by a small margin. The other earnings variables, they beat operating cash flow by a small margin. Their T-stats are higher, okay? And operating earnings performs the best. It's got the highest regression slope. It's got the highest R squared. It's got the lowest coefficient on cash flow, okay? So that's the result we saw in the previous table, but set up as a horse race, okay? Same sort of results. This is where we run the same analysis out of sample. We basically get the same result, okay? Cash flow out of sample performs much better than bottom line earnings. The other variables are in green are pretty much on par. Operating earnings, again, is weakly, very weakly, significantly better than cash flow. Now here's one of the key things. Okay, no analyst is forced to...
Sorry, Ray. Can I interrupt you?
Yeah, sure.
I think Joshua has a question. Joshua.
Yes. Hi, Ray. How are you?
I am surviving, Joshua. How about yourself?
Very good. Thank you. Ray, I mean, this is very interesting because when we worked at the Trueblood report, it was very obvious to us that earnings beats cash flows in predicting future cash flows. And in that regard, we really were thinking about future aggregate cash flows, as Peter Easton mentioned. But relating to this regression that you have with both cash flow and earnings in a horse race, a recent paper by Dan Taylor suggests that if the control variable, in this case operating cash flows, is correlated with the main variable, which is operating earnings, and if in fact there is a measurement error in the operating cash flow variable, this will bias the coefficient on the cash flow, which is on the operating earnings, which is your main variable. It would bias it away from the null. So I don't know if you want to get into that, but I'm just mentioning it.
Yeah. Well,
the measurement errors in the two variables may in fact be correlated.
Yeah. So going back, mean, what is the source of measurement error? Did CompuStat get the numbers wrong?
Well,
operating. Let me finish, Joshua. We're not dealing with a surprise variable here. So if we're looking at earnings surprise and cash flow surprise, now we've got an errors and variance problem. But this is the number that was reported.
Yes. What I'm saying is the operating cash flow can have measurement error as a result of potentially bias. Enron is a perfect example where, in fact, deferred revenue, which was considered as an operating element, was not that. It was financing. So it should have gone to financing section of the cash flow statement. So there is measurement error, which could be correlated with the predictor variable.
Yeah, I know that well. In fact, I testified in court on the Enron, the prepaid transactions which they used to transfer
Right.
cash flow from one category to another. I know that well.
Yeah, I testified on that as well, yes.
Yeah, so we're dealing with the numbers as reported. We're taking the user perspective. These are the numbers reported. We're not talking about what a true variable is. We're talking about the user using the numbers that the company's reported.
Well, fair enough. But if you want operating cash flow as a variable to reflect truly operating cash flow, then it's not. But I mean, if you're restricting the discussion to reported numbers, that's fine. But I thought that you were really interested in looking at the substantively as to whether accrual earnings beats actual operating cash flows as opposed to reported cash flows. Now, there is the implicit assumption that reported operating cash flows is in fact the actual operating cash flows. But anyway,
we're dealing with the system as it is. There would be a problem of the sort you mentioned if we actually had a non-representative sample of Enron-related phenomena. But if you view that a natural part of the accounting system is that errors are made from time to time, so long as you don't have a sample with a higher or a lower than normal frequency of errors, you're learning something about the essence of earnings. It's not some sort of fancy, hypothesized earnings variable that doesn't have problems in it. Okay, we're dealing with life as it is.
Yeah, fair enough. Yeah.
One more question from Professor Basu.
Not really a question, just missing citation. So it's okay. I don't need to ask.
Right. Okay. That's great. Okay. Thank you.
I thought you were going to ask me about the Australia-India series. I'm disappointed. Okay. So
baby.
So let's now introduce some fixed effects. Okay. So here's an excerpt from table 5. This is the one where the version you have, we had an error in actually how we compiled the table, not how we did the calculations, but how we compiled the table. And some of you who are sharper than others would have realized that when we introduced fixed effects, we showed that the coefficient on cash flow didn't change, which of course is nonsense. It has to change, okay? And so here we have the first result, okay? Fixed effects explain about 1/6 of the variance of cash flow in a pooled sample. That's pooled time series cross-section, okay? That's the difference between the two R squareds there, okay? They explain about 1/6 of the variance, okay? Second result is that firm fixed effects drastically reduce the coefficient on operating cash flow, okay? They drastically reduce it. And the third is that operating earnings now almost completely subsumes operating cash flow, okay? So T-stats are 22 versus 3.7, okay? And so it appears that introducing in cross-section a time invariant property of the firm totally changes the way you look at operating cash flow versus earnings. Let's give some interpretation of that. Suppose that we have two firms who invest with different degrees exposed to profitability, a high profitability firm, a low profitability firm. They'll both tend to have high earnings and high operating cash flows versus lower earnings, low operating cash flow. And so one of the ways in which you learn, one of the sources of information about future operating cash flow that comes out of earnings is due to a time invariant firm effect. And that's what this is. This is, among other things, what this is picking up, okay? Here we go to a 2-year horizon, okay? We'll deal with pooling by firm. This is just a pooled sample. And then I'll deal with pooling by industry in a second. We cluster the standard errors by industry here. Here's 2-year ahead prediction. We're predicting T plus 2 from observations at time T. And you can see that what's bolded in red, same result. You get that the earnings number really kills operating cash flow in a horse race. When we pool by industry, this is where we separately estimate by industry, and these are means across industries. We've got firm fixed effects within each industry's pool, okay? So it's a pooled cross-section time series, but within each industry, and we show the means of the 63 industries here. It turns out the T statistic on operating cash flow is 1.8. It doesn't meet the 2 level, okay? That's another demonstration. This is another way of dealing with heterogeneity. It says, look, part of the heterogeneity is at the industry level, okay? And analysts are going to look at the accounting numbers in a different fashion, industry by industry. So an ordinary least squares regression that doesn't build heterogeneity into it is just penalizing variables in ways that users don't face, okay? Another way of doing the same thing is instead of just taking firm fixed effects, which deal with the intercept, suppose you take the ex post means out of the left-hand side and the right-hand side variable, okay, just as a way of doing it. The R squared now falls, okay, from 35% to 3 to 5%. In other words, the time series means really explain a lot. That's what we saw when we saw the summary statistics right at the beginning. Most of the cross-sectional differences are due to differences in the firm's time series means. Operating earnings, again, almost completely subsumes cash flow, okay? What's the, okay, this is firm level time series. This is another way of dealing with heterogeneity. Instead of estimating in cross-section, okay, estimate separately in time series for each firm. So you obviously have to impose some tighter sample selection restrictions to get enough data for the time series. So the results aren't strictly comparable across the various tables. But yeah, here we find the same sort of result. This is a way of dealing with heterogeneity. Treat every firm strictly differently by analyzing its data separately, okay? This is the mean of the 1,724 firms for which we have enough data. And once again, you get the same result. Operating earnings almost completely subsumes cash flow. Now, why not completely? Okay, well, it could be, this is, could be what the effect Josh was talking about. It's possible. It could be simply that it's just a natural property of the system, okay? So here's now replicating something in NAL already. We're doing it with a number of different variables. This is looking at what happens over time. So if we run annual cross sections, and I'm going to show you a series of graphs depending upon what earnings variable we're dealing with. In all of the graphs, the cash flow variable will be the same, the dotted, the dashed red line. The earnings variable in the solid blue line will vary as we go from one variable to another. This is near bottom line earnings, income before extraordinary items. And you can see that this is how the R squared in terms of the 1 year ahead prediction has changed over time. If we go back before the year 2000, it starts climbing, both for cash flow and for earnings, okay? So what do we conclude from this? Hey, it looks like IBC does marginally better. This is, by the way, the firm fixed effects. We discovered that earlier, okay? We discovered that earlier for the whole period put together, but here we see it year by year. The earlier reported upward trending earnings forecastability is evident around 2000. They'll already have that. There's a Kim study before them. And Shivakumar and I published a paper in JAR in 2008 where we showed that the earnings announcement price reaction increased substantially around the same time. Okay, that was subsequently confirmed by a couple of papers that Bill Beaver and Maureen, I think, did. And it turns out that our conclusion is this is just a stylized conclusion. But it would appear that the increased price reaction to earnings at the time of the announcement is in part a real effect. Part of it is Doug Skinner's work has shown, and Shiva and I looked at that as well. Part of it is due to, at the earnings announcement, there are more forecasts or more guidance made starting around that time. Just remember the time of the Sarbanes-Oxley and the global settlement and the restrictions on analyst activity. It would appear that managers are stepping up to the plate and providing some forecasting of their own. So that's part of what's going on in terms of the increased earnings announcement reaction starting around 2000. But part of it appears to be, it's a real effect. Because guess what? What's happening is earnings is becoming a better predictor of cash flow, and underneath that, cash flow is becoming a better predictor of cash flow. Okay, so here's the same result for our adjusted earnings number, which we regard as the second best representation of an accruals-based operating earnings variable for comparison with operating cash flow. That's the second best, but it does better most of the time. This is CompuStat's operating income before depreciation. It does better in almost every single year. And here is our operating earnings variable. It performs better in almost every single year, okay? So what are the conclusions? I think we've got nice time for questions after. We think the spirit, the way in which Nella Reddy and all approached FASB's proposition was to very literally, they said, okay, what if FASB says earnings beat cash flow, what do they mean by earnings, bottom line earnings? They did make a concession by going a little bit up the income statement and taking out extraordinary items, but yeah, why not go further up the income statement and pick something that's more like operating earnings, okay? So they took a very literal interpretation. They didn't quote the surrounding text that says that you, in FASB, the following paragraph that says you want to look at earnings components. So we think the spirit of their famous proposition holds up. It's a foundational issue. It makes no sense to test it by comparing different accruals based on cash flows variables. Firm heterogeneity is important. Earnings are substantially better than cash flows in apples to apples comparisons, allowing for heterogeneity. So the last thing I want to say is to just quote the concept statement 5, which followed soon after concept statement 1, which is widely quoted, okay? And so say, look, analysis of objectives such as predicting future cash flows, okay? You want to have financial information segregated into homogeneous groups. In other words, put like things together that have similar characteristics, okay? They say such as continuity, recurrence, stability, risk, reliability, okay? In other words, sort your income statement items on the basis of predictability, and the board believes it's important to avoid focusing attention to the bottom line, okay? Another way of saying that is, one of the terms that I really do not like is GAAP earnings. GAAP earnings, literally interpreted, is just these, is either net income at the bottom of the income statement, or it could be comprehensive income, okay? But GAAP earnings is usually used for net income. But GAAP very carefully gives you a menu. It gives you a menu where items, according to this statement here of principle, are segregated in terms of what they tell you, okay? And I think that's one of the key results of this research. The other key result being take care to deal with heterogeneity in accounting numbers. So thank you. That's all I've got to say. Thanks for listening. Questions?
Okay, we have about 10 more minutes. So do you have any more question, please? All right, I've got a question from Gia.
I guess I have a comment. Good to see you again, Ray. I think we have a lot of studies in accounting on FASBs and standards and evaluations of them. And I think most of them are cross-sectional. I'm actually encouraged to see you running a lot of the stuff on firm level time series as well. The accounting standards are applied to firm level time series, really. And most of the studies we had evaluating standards were cross-sectional. And the results are not always the same. And I presented a paper here a few weeks ago, and we showed how the results are different when you do firm level and time series and how the conclusions can change. And I think it's very important when we do that, we talk about accrual reversal. It is a firm level time series. There's no cross-sectional reversal of accruals. So I think I'm encouraged to see that move in that direction. So thanks, Ray.
Yeah, I mean, Valerie and I discovered that same result in the paper we did on the Basu conservatism estimator, where firm fixed effects in that context were very important. And yeah, there's a lot of cross-sectional stuff that's done that doesn't really address the heterogeneity issue. One aspect of that I'd like to point out is people just scale. If they pull a scale out of the hat, well, following A, B, and C who use total assets will use total assets. So following people C, D, and E who scale by price will scale by price, okay? And when I see the word following, I cringe. In other words, yeah, you should give your explanation as to why that's the appropriate scaler or whether you should scale at all. And one of the things about scaling by book value is that what you're going to do is introduce a firm invariant effect or a firm effect due to how well book value represents value. And so if you think of intellectually property intensive firms, okay, scaling by book value in cross-section is going to, if you scale all the variables, is going to introduce cross-sectional dependence simply based upon the scalar. We've discovered that in asset pricing stuff. We've got a number of papers. We've got a paper called Deflating Profitability in the Journal of Financial Economics, where the scalar really matters a lot. And so, yeah, I agree totally. If I see people saying, by the way, the major reason to scale in the first place is heteroscedasticity. And there are other ways of addressing that, okay? But that's the only reason I can find. In the finance literatures, scaling by price has not only the advantage of dealing with heteroscedasticity, because you're then scaling by market value of equity, okay, it has the advantage that you get a rate of return, which has an intuitive interpretation to it, right? But so the major reason in our literature to scale is for heteroscedasticity. You've got to realize that that induces cross-sectional effects. They're going to still be there in time series, but they won't be as important, okay?
So David, you have a question, right? So no response. Right, I think Peter Easton has a question.
Can I just follow? With all respect, Steve, I'll probably get it wrong, but I think what Steve was saying.
Could you start again, please? I got your noise was very there was noise in the system when you started.
It could be the guys working outside, right?
Thank you.
Just to follow up on Steve Monahan's question, which, as I just said, I might well have wrong, but I think what he's saying is that if we find, as Paddy Deshau did, that cash flows are less correlated with returns or price changes, then doesn't that suggest to us, isn't it sufficient to point out that since prices are the present value of future cash flows, that earnings must be a better predictor than cash flows? In other words, what do we learn from forecasting just cash flows as opposed to price, which is the present value of future cash flows?
Okay, now I understand the question. In fact, we were going to point that out in the paper, and we will in a future draft. Remember I said there were two types of tests that were put up in the literature in the 60s and 70s, and they are related if you view price as present value of cash flow, right? Exactly. The reason we didn't have it in this version of the paper is we hadn't yet addressed free cash flow, because every finance person is going to jump on you and say, no, price is present value of future free cash flow, right? And so, you know, that
sort of gets back to my question, which is why operating cash flow instead of free cash flow?
Yeah. So we'll be paying much more attention to free cash flow in the next version. And as I said, it raises the issue of what the time series behavior of CapEx is. Because if it was a mean reverting process, the average of past CapExes would be a better predictor of the future, right? If it was like temperature on July 17, right? You take the average of the last 150 years, okay? You don't take last year's July 17. Right. So if it was a mean reverting process, then depreciation would beat last year's CapEx, but it would appear that last year's CapEx really beats depreciation by a substantial margin in forecasting future free cash flow. So if you take earnings, whip out depreciation, add back last year's CapEx, you do well.
Thanks.
Ruby, you have a question?
Hello, hi. I'm actually just following up on that point, because of course, you know, price is the present value of future cash flow, but those are cash flow potentially are available to shareholders only. So for that, perhaps for that reason, you know this much better than me, that a lot of equity valuation models are based on earnings figures rather than cash flow, operating cash flow. So I'm wondering if it's worth investigating the case that the dependent variables is operating earnings instead of operating cash flow. Because a lot of, as I mentioned, that's a lot of equity valuation models based on the cash flow distributable to shareholders as a function of future earnings.
But if you're talking about the present value of future free cash flows, right? You are removing from the operating cash flow the amount that the firm reinvests. So the rest of it has to go to the shareholders.
Yeah.
So there's no problem.
Right.
Yeah,
we have
that makes sense. Yeah.
We have 2 more minutes. Probably there's one more quick question, because we have to finish in 1 hour, right? So 2 more minutes. Oh, Jamie, do you want to say something?
I'm sorry, this might be a very basic question, but I just wrote out there that can you do this, extend this analysis beyond cash flow over the next 2 years? Given that the main concern, and I'm speaking not as an academic, but as an ex-analyst really, the main criticism analysts always had about earnings figures, even operating earnings in which you ironed out the distortions, is that they don't give an indication of long-term sustainable cash flow.
Okay, so you're saying if it'd be nice to see us extend the horizon beyond 2 years?
Yeah.
We're thinking of doing that. You start imposing more sample selection criteria, but we'll look at that. But remember, that's basically what you are doing when you look at price. And if you go back to the previous discussion, if price is present value of future free cash flow, Patty DeShau's thesis paper, the 1994 paper, is really telling us, okay, if you take the horizon of the investor, okay, earnings beats cash flow. And so, this is, And given my background, I would always prefer a price-based test to the sort of test that we're doing here. Okay, but I think that there's a I suspect that as we increase the horizon, it'll up to some manageable number for research purposes. Okay, because you only have 30 odd years of data. That's right. FAS 95 was in 87, so we got 30 odd years of data. We start losing observations, but if we extend it up to a horizon which is manageable for research, my prediction is we'll get the same result. The reason is this firm fixed effects issue was so strong. You're getting this time invariant effect that a high profitability firm now, you're going to be high profitability for a number of years.
Okay, so we need to finish the workshop on time. Thank you, Ray, for this interesting talk. I would like to thank Stephen and Anyang for organizing this virtual workshop. Thank you all and stay safe.